Welcome to the Titans of Industry show. This is a special COVID-19 update show, and I have Jason BODNER, who is a returning guest, one of my favorites by far, because talk about someone who has a very rational approach to investing, a very strategic approach to investing, and literally a fine-tuned approach to investing. He doesn't do 99% of the strategies. He focuses on one, and that's all he does. And I actually love that because he's not trying to show you, hey, I got this on one sleeve, this on the other sleeve, I got this rabbit out of the hat, etc. It's all about one strategy that he focuses on and masters. And we'll get to hear from Jason today. So thank you for being with us.
Thank you for having me. It's an honor to be back. I wish it was under better circumstances, but I'm glad to be here.
Yeah. The entire world, or half of the world's population, is actually quarantined. So 4 billion people, I think the last count was 3.4 billion in total. But touching on 4 billion here very shortly, which is unprecedented and actually very unique that we're all, as a human race, trying to solve one problem. It makes me think about what we can do if we looked at other problems as a total human race. I wanted to, right off the bat, ask you, how close was the system to hitting the brakes altogether, like closing the stock market, perhaps closing the banks, maybe there's shortage in ATMs, all that kind of stuff that's really panic stuff. Not a shortage in toilet paper, but actually a shortage of society, like no one having any way of reaching its money market accounts, etc. Because usually on a risk-off event, correct me if I'm wrong, you sell stocks, you buy bonds. That's the usual risk-off event. And here you have a situation where people sold stocks, bonds, precious metals, everything just went to dollars. And I wanted to ask you, did the Fed save the system? And do you think that the way they saved it is actually going to be more bad than good? Is the cure more vicious than the problem?
It's a great question. Great way to lead off. What I would say is, we didn't forecast a complete seizure of global economy. But our research, what I do, it's very data driven. It's black and white, it's numbers. And we measure big money moving in and out of stocks. And our data showed that we became overbought in late December. So all that means is we were seeing way more buy signals and sell signals, so much so that it was unsustainable. It just couldn't, that level of buying couldn't keep going on forever. Now, we were alerting our clients, listen, you don't want to be buying stocks up here. We're overbought. We expect a market pullback. In some of our services, we actually converted to 40% cash along the way, taking profits along the way on some of our long trades. And, we were very clear. Now, by mid-January, we were extremely overbought. So you can stay overbought for a little while, okay? But what's interesting is when that data starts to fall, when the selling starts to pick up, that's when you want to pay attention, because it usually precedes a nasty, nasty pullback. Historically, in my data, we go back 30 years, okay, back to 1990. So, and in the beginning of February, markets were still going up, and we were looking at all this COVID stuff on Reddit and some of the chats, and it was emerging in China. I think at the time there were like, 1,000 deaths. It was still relatively small relative to what it is now, but our big money index was falling. It was telling us that people were getting out of the market even while the market was going higher. So that's kind of what you want. You want a little divergence there. So what I will say is our data doesn't predict like how deep a sell-off is going to be or the economic impacts of what we're seeing now. So the answer is, yes, we foresaw a pullback. No, we didn't foresee, the halting of a global economy and a national and global pandemic, causing people to quarantine. But so what happens is when this data says, hey, there's a sell-off coming, then we measure it the other way. So we went oversold on March 19th. Okay. So 30 years of our data says when we get oversold and extremely oversold, we typically see big market bounces thereafter. It's data, it's just black and white. And this selling that we saw the past 3 weeks, and I'm sure you've read headlines of hedge funds going out of business and, investment managers unable to meet margin calls and having their portfolios liquidated. It screamed of liquidation. Deep selling, big blue chip stocks down 10, 15, 20%. Basis trades went wrong. VIX volatility products exploded, all that stuff. So when all that happens, to answer the second part of your question, did the Fed save the system? Yes, because when overnight liquidity dried up in the repo market, that overnight lending, it was non-existent. It reeked of a repeat of 2008, and that's what sort of triggered major Fed intervention back then. So they injected liquidity into the overnight market. They pledged initially SBA loans, things like that. They rushed to provide liquidity. Now, where we are, your final question, is the cure worse than the problem? It's kind of an experiment. You just hit it on the head. This is the first time it's affected everyone globally. We've never shut down the United States, the number one economy. And granted, businesses are still operating in a limited capacity, but this is almost like an experiment. My personal feeling is, yes, they saved the system. They pledged the liquidity. Maybe we'll talk about, I don't want to take up too much of the time on one answer, but we can talk about what it might lead to in things to come. But for now, I think it was required to inspire some confidence in the markets, in everyday people, workers, laborers, big companies, small businesses, everything, to know that, yes, there's liquidity there, it's available, we're not going to let the markets fail, etc. So yes, I think they acted responsibly.
Jason, just two quick follow-up questions with a yes and no type. When you say what's coming next, do you mean or do you imply that there will be higher levels of inflation? Yes or no?
Yes.
Yes. Okay. And then is your system now overbought again? Just a yes or no?
No, we are actually oversold. No.
So even after this record 20% gain in 3 weeks, and today as we're doing this, it's up like 2.5%, we're still oversold.
Yes, that's right.
Interesting. Okay. So, let's talk about something very unique. There's a lot of chart plotters that are analoging this compared to the Dow Jones activity in the 1929 crash. So they're looking at this crash, the 1929 crash, and then Goldman and even JP Morgan, they're out today with, hey, during the 1929 to 1932 crash, where the Dow Jones went down, I think something like 90%, we saw 9 times where there were bounces of between 9% and 19%, which they called obviously a bear market bounce. And then headed lawyer, is this history rhyming or repeating or something like that? Or do you think that the bottom was already set and we're kind of going to churn? What is your opinion of what's going to happen? I can tell you that for me, what I see always is that the Fed always said the Great Depression was its greatest mistake, that he didn't intervene and didn't do. And we saw Neil Kashkari going on 60 Minutes saying, we have an infinite amount of cash. You will always have money, like reassuring the entire public and investors that the Fed is going to do everything. And I've seen these charts where they're going to have a balance sheet of about 10 trillion, which is unbelievable, double what it is today. So, where do you stand with this just as an economist, as an investor? How do you work around this?
Well, in answer to your question, is there an analog to 1929 and will the market rally then sell off again? I don't really see it that way. Looking at 1929 to draw a parallel to today, it's not really how I measure data. You said it in the beginning. I don't do things typically. The cause of today's events are extremely different than what led up to the crash of 1920. They're not the same. So to expect the same outcomes by matching charts doesn't seem like a worthwhile exercise, to me, in my opinion. So a lot of people out there expect that we're going to retest the lows that we set in about a week or so ago. And my data doesn't support that. So what my data is saying is that it's supportive of a bottom being put in, just because of the level of selling, the aggressiveness. We had for 5 weeks, 98% of all my signals. So keep in mind, I'm measuring big money going into stocks in an unusual way or coming out of stocks in an unusual way relative to some comparison, a few weeks or whatever. We're going to take a stock and say, this is normal trading activity. This is wild activity. That's what I'm looking for. 98% of all my signals for the last 5 weeks were sell signals. That is so extreme that it's only happened 4 times in the last 30 years. And one of those instances was last week. So that's ultra rare of being deeply oversold. Okay, so all 3 prior instances were in nasty bear markets, one of which was the great financial crisis. So what do we see coming out of those 4 events? Well, we don't know last week yet, but the 3 prior events, looking 1 to 3 months out, the returns were kind of ho-hum. If we look at the S&P 500, somewhere up, somewhere down, on average, you didn't really make any money. But if you look 6 to 12 months out, the returns were very strong, on the average of plus 20% from the moment we went so deeply oversold, like I told you on March 19th. So looking at last December of 2018, when the market just kissed that bear market, minus 19.8%, we didn't even come close to the level of oversold, and you saw the massive bounce we saw then, which was largely technical, and the economy, the setup was a little different. But personally, I think we're in for big positive returns 12 months from now. I'll leave you with this. Markets like poker, right? If you get dealt pocket aces, you can still get beat by that hand. But odds say you got to bet big, because the odds are in your favor that you're going to win. So that's kind of how I see the market right now.
Understood completely. I want to ask you a quick follow-up question, just a yes or no on this answer that you gave me. If there's a second wave of deaths, so a sudden spike in death, will that change your perspective? If we need to lock down again, or in China or somewhere else, if there's a second resurgence of this pandemic? Just as a yes or no, or just a quick answer.
No. The quick answer is I don't deal on sentiment. I deal on data. So if the lockdown ripples through the economy and there's seizure of business, then perhaps yes. But the market's forward thinking, and right now it's thinking we're going to peak, we're going to have it under control, we're going to bounce and reopen our economy.
Okay, well, I really hope that's the case. Actually, I saw today a very nice documentary about 35 different drugs that are being tested right now. Now, some are already being implemented, and plus
a lot in Israel.
Well, right? I can't comment on that. No, I'm just kidding. Yeah, there's a few, and but obviously one giant American company has just come out with I think a 5-minute diagnostic test, and so that's going to be big. And there's like 35 different drugs that are being tested and even used. Some locations, some doctors are just taking on the spot decisions. This patient can take this dose of this medicine, etc. So let's see what happens. Like I said, I'm very optimistic that if the entire human race is focusing on one single problem, it will have the ability to to solve it sooner than people think. I'm not talking about the vaccine, but just on drugs and medicine. I want to ask you, okay, so now there's a 40-year-old person and a 60-year-old person. They sit in front of you, and each of them is asking you, how should I manage my my stock, not my stocks portfolio in terms of which companies should I buy, but how much should I have exposed at this particular point? Would the answer be the same because there's a big oversold data, like you're saying, or should people be thinking, hey, my retirement is close, I should do something about this, compared to the person who's 40 and still has 20 to 25 years ahead of him of investing?
It's a great question. Great question. You know, the first thing is always the disclaimer that individuals should obviously always consult with their financial advisor. But, you know, a 40-year-old, their needs are obviously different than a 60-year-old. Hopefully they have maybe another up to 30 years to work. 60-year-old doesn't have the luxury the same time. You know, I would say it's a great time to allocate to equities for the 40-year-old with a longer time horizon. Bonds are yielding next to nothing anyhow right now, right? And if you're 60, you're likely to have more bonds in your portfolio than the 40-year-old, which probably mitigated some of that ugliness seen in the equities. As you mentioned, everybody was selling everything, but still, I think bonds were a little less volatile than equities. So if I were older and the 60-year-old, I would be allocating some of my money to strong companies with a history of paying dividends. They're likely to weather the storm. They probably have big cash positions on their balance sheet and low debt. You know, looking back over history, there are many companies that survived, you know, bear markets, decades and decades, and are essential to the commerce of the United States. And you know, I'll go one further. Let's push out the horizon even further. For my kids, for the past 3 weeks, I established accounts and I went out and I bought stocks because they have decades and decades to think about it. So it's, you know, it's on the opposite end of the spectrum as a 60-year-old, but hopefully we will look back and say this was a huge buying opportunity, and I might even get a thank you, Dad, although I'm not holding my breath. But,
you know,
that's how I'd answer that one.
No, it's completely understood and understandable. And I want to ask you, you know, something that I've just thought about. Is there a possibility that we will actually see, with these low oil prices and high precious metal prices, do you think that there's a chance in your data that you will start seeing operating mining companies look more attractive than some of the companies that have led in the past 9 and 10 years of the bull market? Because it looks like there's a significant portion of the world's mines that are getting shut down because of the virus. About 25% of the production of precious metals, for example, has been halted. As you know, these are not taps that you open and close. It would take months to then reopen them. Is that something that you think is a possibility? And it's also sort of an inflation play on this rescue package, $12 trillion around the world, zero interest rates everywhere you see. China's just lowered their repos today to their lowest ever. And, you know, every American family is going to get a check. I don't need to tell you. I mean, the size of this package is, it's mind-boggling.
It is mind-boggling. Yeah. So in answer to your question, it's going to be a two-part answer. I'll keep it short, I promise. But, you know, there's the thinker, the sentiment side, and then there's the data side. So the sentiment side says, hey, if mines are shutting down, then there's going to be less supply. It's going to mean higher prices. So when the workforce comes back online, there will be better margins to explore once more production ramps up and more incentive to ramp up production. And yes, I think the mining companies' margins will start to look better. Now, the data side says, I'm going to wait until the big money shows me that, right? So what am I doing? I'm tracking the movements formulaically, with math, of what I believe when big institutional investors are moving into stocks in a big way. And oftentimes, an idea like that will spread through the community, and all of a sudden, before they've even returned to the workplace, you'll see buying in the miners, in gold stocks, in copper stocks, etc. And when I start to see that in my data, it's going to be a confirmation of exactly what you said. And it happens constantly. You mentioned energy. Way back in December and January, on our sort of short opportunities, we were seeing a lot of sorry, I just had to scratch a mosquito. We were seeing a lot of energy companies showing up in the for sale section of our research. And obviously, that was before they slashed, Saudi Arabia decided to slash their production prices, and we got into this nasty energy downtrend. So typically, the smart and big money knows before. So back to the miners, I'll look for the answer in my data.
Understood. Okay, so last question. Is this a good time, in your opinion, to invest in real estate outside of the stock market, far less volatile, far less liquid, so maybe less swings because it's not as easy to create buy and sell orders? Or is it going to be nasty with people not able to pay rents, businesses not able to pay rents, the entire mortgage industry in sort of a negotiating period on how to come up with the funds to pay the mortgages? What is your opinion of real estate right now? And I'm talking residential real estate as an investment, not as a decision whether I should rent or own.
Well, I think if we're going to, focus solely on residential real estate, I would imagine there's going to be more pain to come. So if you're looking to invest, I'd probably wait to sort of opportunistically look over asymmetrical payouts on real estate investments when things get so depressed and so low, and it's just, it's virtually zero cost of carry to carry that investment. Spreading to other sides of the real estate market, you mentioned mortgage real estate. It's obviously way more volatile recently. But there are some areas of real estate that I think would do well in some of the REITs, like, utility REITs or something like AMT. I think they build cell towers and they own the property on them, and they're organized as REITs. With everybody telecommuting and doing stuff like you and I are doing, there's going to be even more demand for 5G, more towers. Those are stable. Storage REITs, if there is a residential, pain point and people have to downsize, they're going to put their stuff into storage. I imagine those would do well, but sort of the leisure REITs and the travel REITs, no thank you for right now. And I would definitely stay away from those until the picture clears.
Jason, you run, and I believe you're the founder of Mapsignals.com. Could you explain what that service is?
Yeah, sure. It's a research service. So basically, look, we're not a traditional newsletter. We're unique. We're data-driven research. And if you want to see insights and observations you can't really find anywhere else, that's what we do. So anyone out there interested in a data-driven approach to looking at stocks and entire equity markets, come to Mapsignals.com. You can sign up for our blog posts. They're all free. We also have subscription level services catering to the beginner trader all the way up to the beginner investor all the way up to the advanced trader. And we give trade ideas weekly and all about stocks, options, etc. And, you know, for those of you interested in that service, you could come to Mapsignals.com. You could use the code FUTURE25 and you'll get 25% off annual subscriptions for the, I don't know, the next few weeks. The details will be up on that page, but if that's what you're interested. But come by and check us out, sign up for the free stuff, and have a look.
Jason, thank you very much. This was very insightful, and I'd love to touch base in a few months to see what has happened with, obviously, with COVID, and what is your data and research telling you.
I'd love to do that too. You know, we have a lot of touch points that we can still talk about and revisit, but I am a glasses half full guy, so hopefully we'll be having you know, an optimistic conversation in the coming months. But Lior, thanks so much for having me. I really appreciate it, and I look forward to being back soon.
Thank you, Jason. Thank you, sir.